Welcome, everyone. And you were actually invited, sort of this more intimate setting, because we're so excited about what we're doing here with the Leadership Pegasus report. And Hugh will actually go into a lot of detail around it, around the science of it. But back in October, we started, Hugh's been thinking about this for a long time, but we really started talking about how we could create the Pegasus report, the ratings report. So it's fourth quarter, we talked about it. First quarter, we talked about it. Then we had the digital scan, which Hugh will get into a little bit more detail. That really unlocked the ability to do this. And I think most people know, Hugh and I come from an accounting background. And one of the things we always learned in business school is that you don't capitalize human capital. It's not something that can be done. But I think we've unlocked it as close as you can around financial creation. So I think we've been celebrating here at DNA Behavior because this is really revolutionary for the company. A couple of other things that were really highlights for the year. Hugh is named Georgia Titan 100 CEO of the year back in February, and we're all excited about that. It's been a great opportunity to really expand sort of our work here in Georgia. And then just last week, sort of Ryan was a little bit of the driver on this, but we had our Financial Planning Magazine Innovation Award. We were nominated for winner of the Client Onboarding Technologist of the Year, and that's really related to the AI work that we're doing. So it's been a remarkable sort of first half of the year, and I know it's going to just continue for the rest of the year. So we're excited. Again, most of you on this call, or all of you, really were invited because we knew you'd really get the concept here that Hugh's going over. This is going to be widely distributed probably in the next 30 days, but we wanted to give you a preview of what we're doing. And please, we want to make sure we even keep it open. So if you do have a question, just drop it into chat, and then I'll give Hugh a signal if we need to get a little bit more details. With that, Hugh, I'll turn it over to you.
All right, Leon, thank you for the introduction and for everybody for coming along this morning to listen to these, what we would call game-changing research findings. I think us being able to connect leadership to financial behavior has been a dream of mine for the last 20 years. I've intuitively seen it in every case that we've dealt with as a company in my prior career. It's always shown up, but I think now to be able to put measurement to it is very exciting. And to be very bottom line, it is absolutely true that behavior makes money. Now, the question is how much money does it make? And I'm going to tell you that at the end of the call. So you've got to stay to the end, and you're going to get the number. But just to do a little bit of level setting, because I want to make sure I don't lose anybody on this journey. I think, as all of you know, we started the DNA behavior business in 2001. We built what we believe and still maintain is an extremely powerful behavioral assessment process using our 46 forced choice questions. It's unlocked over 4,000 insights. And as we do more client cases and experience situations and do more validation work, that number increases. But an inherent barrier in a way to the exponential growth of our business is actually the profile completion itself. And I think we've done a pretty good job at getting 2.5 million or so people as of the end of last year, and that number's growing now to complete that process. But I think a lot of for example, in the financial services industry, there's a reluctance on a financial planner to get a client to do any more work than they need to get done. What can the planner do on behalf of the client? We've had all those pushbacks. We've had pushbacks with coaches. We've had pushbacks with leaders. Generally, what I've seen is, though, that in many cases, that pushback is actually just the fact that that person doesn't want to know as much about themselves. That is one, and it is a question of time. But how do we unlock that barrier? Well, that's where we've moved to the DNA digital scan, and with the power of AI, we're now able to have our assessment automatically completed by AI, and then the results just feed into our system, and the 4,000 or so insights that we have can get automatically produced. So, you know, what we've done is we've reverse engineered our own system, and we are in a way reverse engineering our own business model to basically now put the digital scan at the forefront of the business. And then by having multiples more people or exponential amounts more people complete the digital scan or be digitally scanned, we know that the interest that will create for people about who am I will lead to far more DNA full scans being completed. So you know, overall, this is a major strategic move for us. Now, when I started DNA, a lot of really, if I put it all down to one word, you know, my goal was to hyper-personalize experiences for clients, particularly in the wealth management industry, but it would be equally true in any other situation, you know, healthcare, education, career development, wherever you want to go. How can we create a personalized experience at scale? The digital scan allows us to do that. And as Leon mentioned, we've won the Wealth Management Award for onboarding, and we're also one of the finalists for Innovator of the Year, full stop, in financial services. And because of the digital scan and the possibilities it now opens up to enable every financial planner, wealth manager to know, engage, and grow their clients from the outset to be matched up. But it also unlocks a whole lot of possibilities in the leadership arena around allowing, whether it's an investor, a board, or leaders of a company themselves, to understand the people around them, the people that they're investing in. And this is really what Pegasus Ratings is all about. And I know that you've all had access to the report. So the digital scan serves multiple purposes. And, you know, in a lot of ways, today's presentation about how we're going to deploy the digital scan into the Pegasus Ratings business model to rate leaders is about demonstrating our capability to do the digital scan, but also to create new business models. And so I will now focus on the Pegasus Ratings, but hopefully you all get the bigger picture of what we're doing at DNA in pushing forward with the DNA digital scan. So really, I think out there in business, the holy grail, as far as looking at a company is concerned, is to understand what is going on in the company's mind, and imagine a future where we're all operating as business leaders, where we can, with one prompt through our computers, know what's going on inside of a company. The accounts tell you the past. The leaders tell you what's going to happen in the future. And I think that's a very key message that I want you to all think about. And, you know, our proposition is that the money mindset of leaders drives 80% of the business valuation. And you're going to see that come through as being true as we go through the presentation today, because I'm going to show you some of the statistics that allow that to happen. So this changes the game for leadership, full stop. And you know, I think you all know that we've written a book, Leadership Behavior DNA. It talks a lot about the usual behavioral approach of understanding results versus relationship type leaders. They generally tend to be opposite. If you want to get better results, you need to work on the relationships, which requires emotional intelligence. That's all fundamental. That is all true today. The part that we haven't talked about very much and needs to be talked a lot more about is the financial value creation capability of those leaders, which is somewhat tied to the results behaviors. But as we'll see today, there are some very specific behaviors sitting underneath the the financial value creation capability, and that's what I'm going to unlock for you. So the way we are approaching this is that as a leader, at the end of the day, your primary responsibility is to create financial value for the shareholders. And so in looking at leaders, particularly the CEO and the key and the C-suite, and we're going to look at the dominance of the CEO in terms of behavioral impact on a company, they need to be, in a way, cut from the right cloth in a financial value creation sense before we even have a discussion about leadership development. Because understanding and dealing with the results and the emotional intelligence really only works in creating value if the person's got the right talents in the first place. So what we see, Pegasus ratings doing is being the new gold standard for predicting leadership performance. And as I alluded to at the start, this is something that we've wanted to do for, certainly I have for 20 years, but having, Leon on the team and a number of our other executives who've got accounting backgrounds, Ryan, we all see how behavior connects to the numbers. And I think, just from a story perspective, when I had my wealth management business, I was asked by a very wealthy client one day, Hugh, should I invest in this insurance company? And it was in Australia. And I said to him, no, you should not invest. And that was just outright intuition. In a lot of ways, it was intuition. But I had already started to figure out that when there is a major strategic shift in the direction of a company, which comes with changing management at the top, that the outworking of that will be seen 5 to 8 years later in the numbers. So when this person, investor, client, asked me that, the company was about a year into, as an insurance company, converting its business from being very successful as a short tail insurer, insuring or underwriting motor vehicle type policies where the claim would be made inside a year if there was to be a claim, to what's called long tail business, where the outcome as far as the insured event wouldn't be known for 5, 6, 7, 8 years. And the reason that insurance companies do this is so that they can increase the investment returns. But they're also putting a lot more risk into their business. And you have to know how to underwrite that risk. The company didn't. And lo and behold, 6 years later, and 7 and 8 years later, it had disastrous results because all these claims came in. And it effectively destroyed a major insurer it was in Australia at the time. And now the company still exists, but it's not the same company that it once was. And I think that's what we're talking about here is that, and I want to make it very clear that what the top brass, the top level leaders do in a company, particularly driven by the CEO, will be seen through the results many years later. And when I was an even younger puppy, a few years before, and I was leaving Arthur Andersen, I could see things going on there. And in my exit interview, I was asked, what do you see the future as? And I gave them the 1, 2, 3. And I said, if you don't fix this, the company won't be here in 5 or 6 years' time. Well, it wasn't. And it wasn't because of Enron. It was other behavior. And so, I'm not saying that I am a prophet, but we do have, and I suppose it's a gift, the capability to sense what might happen with a company when you connect behavior and the numbers together. And there are other telltale signs. So as I've said already, the accounts only tell you the past. The behavior predicts the future. And I think one of the important things with Pegasus ratings is that when you see a management change in a company, you know that there's going to be a difference in the financial results for the better or for the worst. And I think this is a great opportunity for investors, boards, and even leaders to be looking at what is going on in a particular company when leadership changes are either needed or happen. So the past somewhat becomes irrelevant. We can also, one of the things I've seen with PE type deals, merger and acquisition deals, doing due diligence work with that, is that there is an over-reliance on the financial analysis, and then somehow at the end of the process, the intuition steps in and overrides everything, and then you get these, and it's been scientifically proven there's a 41% variation across valuations by different people with the same set of numbers. And why are they coming up with a 41% variation in the valuation? And I think that if we understood more about the behavior of the people making those assessments and of the leaders, we'd close that gap down. And I would be emphatic to say that in any deal that involves M&A, where there's a big transaction going on, most of the time the investors don't know who they are investing in. It is all by intuition. There's a whole lot of guessing games going on. And Pegasus overcomes that barrier. I think there's no excuse now for anyone to say, well, we haven't got time to get behavioral assessment done. As I'm saying to you today, that can be done with a digital scan at least at a 75 to 80% accuracy level with one prompt into your computer. You can get a lot more insight that it's going to at least give you the clues of what questions to ask next. So we believe that Pegasus has got a lot of ratings, has got a lot of relevance and value there. So what are we doing? The benefits really are the other side of the problems there that I've spelled out: more transparency earlier, improved governance. And I think this will be at the board level for a board to understand in major decisions getting made who is pushing what decision in the particular settings. Where's the authority bias coming from? Is all important, and what bias is being brought to that decision, and then the ability now to do better due diligence by reconciling the behavior of the leaders to the financial projections. And that's in essence what we've done to build the Pegasus rating system so far. And that's what you're getting, the benefit of in this report, is that methodology where we have reconciled the accounting of the S&P 500 companies to the people that are leading those companies. And AI can do that for us. So we've got a platform set up to do that now. So the outworking of our research is we see a new leadership financial behavior model, and it's really predicated on having 6 key indicators. So the first one is measuring a person's results drive. We've always done that anyway, but knowing that number, what's the person's or the leader's relationship engagement capability, and from there, their preparedness to invest in the people culture. So, we've always brought out that there is it's not an exactly opposite relationship between these two, but the results-driven people tend to be not as relational. But at the end of the day, relationship engagement does boost profits, and I'll show you that in a minute. So it's important that if you are a results-driven leader, that you invest in relationships. And then there is the sort of third leg on the stool is governance, and that sits around measuring financial prudence. But before I get to that one anymore, I want to come back to underneath the results drive. We look at 3 specific metrics here: the financial goal drive, the innovation focus, and the fiscal control. If on a combined basis, each of those is strong, the financial value creation capability of the leader and the company will be high. And what I will show you as we go through, it's important that they're strong in the CEO. So for any company that's looking at hiring a new CEO or investing in the CEO in an M&A deal, you need to be looking at these three traits. Now, interestingly, if the CEO or the leader is strong on fiscal control, they tend to be financially prudent. So the fiscal control is really around using the financial resources properly in the company. The financial prudence is around making having the right processes for making fundamental high stakes decisions. So they do somewhat go hand in hand. And just to spell it out, the financial goal drive, which is very important, is around the company's sales pipeline and its competitive drive and follow through to sell that pipeline of products that it has hard. And we'll see in a minute, that's the most important one. But with it is innovation focus. Without innovation and the ability to create new products and to invest in those products, the sales pipeline is going to fall empty at a certain time. So if the company, in a way to fill that sales pipeline, must have innovation focus. So that's a key trait. And we can see here that, in essence, with these leadership competencies, these 6 key leadership competencies, as they increase, so do the profits relative to a company's peers in its sector. So on average, and the important one, and one of the key ones here is the financial goal drive. For a 4% increase in the financial behavior strength there for financial goal drive, it leads to a 21.51% increase in profits. But that will only happen for as long as it's got a strong sales pipeline. It's a strong product pipeline of, in other words, a pipeline of new products coming through. So the company's got to keep reinventing its products and solutions. And there are inventors out there, but the management team has to have the courage to invest in them and invest in the right ones. And something I would say that's important, and we'll see this later when you see which industry sectors are doing better than others. I think the best practice has got to become that if the innovation focus is not strong enough in the upper levels of management need to go down into the company ranks and find it. And they need to be prepared with the right nurturing to elevate maybe a younger person in their mid-30s to 40. That's the prime age for this, up to a chief AI type level officer type level person in the company. That's got to be a part of the strategic thinking and the actions of the company. If in today's age where everything is changing fast, the company's going to survive. Fiscal control doesn't lead to as much increased profits, interestingly enough, but without it, the resource utilization goes out of control. And so you get more of a boom or bust in the company. So you can imagine if the company's strong at selling and strong at innovating, but if it spends a lot of money doing it, it won't be as financially successful. So it's important that we look at all those three together. And then the financial prudence is really about the maturity in the decision-making structure inside the company. And this is particularly important for these S&P 500 companies, and I think the companies involved in private equity that are larger, there's more infrastructure, more people involved. They need to have the right decision-making processes. So I'm not going to take you through the weeds of all the graphic here, but other than to say that for the research that we did the digital scan on 4,859 key executives from 495 of the S&P 500 companies. So we accessed the public company records for those companies with a prompt, So Ryan designed the prompts, and we let the computers run, if you want to call it, overnight, and it then produced the behavioral results, and then we were able to do an exercise where we used AI again to reconcile the results to the accounting, and that's what's led to this research. And then we've gone and tested it, against the success of those companies, the profitability of those companies. How does that stand up if we were to build a portfolio, which I'm going to tell you at the end, what the portfolio outperformance is. So breaking it down, it probably no surprise to any of you that 69%, so let's say 70% of the S&P 500 key executives are very growth and results orientated leaders. So in our system, they're called influencers, initiators, and strategists. The other 30% are more relational, people orientated. There were two styles that didn't come up at all, which is the facilitator and the relationship builders, which are the most relational leaders, along with the community builder. And the community builder sits in here. You can't read it that clear, but it's at 3.45%. So that sort of gives you a feel for the dominance in this of pretty results-orientated leaders. And so you can imagine in a company, if the top level of the company has these types of traits, what's going on? And it was interesting, in 2004, believe it or not, with one of the first really big engagements I did. I was still living in Sydney, although I started to commute to America. We had launched Financial DNA already at that time, and we were just starting to launch Business DNA. So one of the first Business DNA engagement I had was with a major listed consulting firm. So it was one of the spin-offs out of one of the big, well, today what is the big four accounting firms, was one of the spin-offs out of there. And I didn't have all the knowledge and resources that we have today, but we still had the core system. 21 out of the 25 leaders were strategists and initiators. They didn't have so many influencers, and CEO was a strategist. 21 out of the 25. They were fantastic at new sales of new clients and fantastic at recruiting talent. And a lot of that was from the brand name. But they had a massive client retention problem, and they had a massive employee retention problem. And it was basically a dogfight in that organization every day. It had a very poor culture. And I was essentially brought in to facilitate those 21 or those 25 leaders to get them better working together. And I realized that the problem they had was a lack of trust. They had all the financial behavior, but there was a fundamental lack of trust. There was very poor relationships. That was filtering through the business and holding it back. And the recommendation at the end of the day was to hire a people culture manager or leader that would report to the CEO. But in the end of the day, they didn't want to do that. And to be honest, in that market, that company has not really progressed. And I think that, it plays to my point that you can have the right financial behaviors, which is important. That's foundational. But the relationship side still needs to be looked after, because it is the glue and foundation to the organization. So the leaders do need to invest in this, even if they haven't got those talents themselves. So let's break it down a little bit more and look at the split of styles between the CEO and the executives. And we see that there's a dominance in the CEOs. There are more the influencer. That's the strongest one. That's actually 42% of the CEOs are the influencer style. Then the initiator is the next strongest, next most prevalent one, and the strategist. And this becomes important later when you start to see what are their behaviors and how does that influence the company. And we can see here that, back to my point on results versus relationships, basically 71% of the leaders overall have a 71% results drive versus a 33.8% relationship engagement motivation. Those numbers essentially are opposite, but they're not exactly opposite in the way the measurement is done, which just brings out the point that the adaptation of the results-driven leaders to have some relationship engagement or invest in it is important. It's also probably a reflection, I should say this, that the more relational leaders may be sitting at the next layer down of management. They are still needed to nurture that culture, but they may not be the out the front charismatic leaders of the company, the influencer style, but they are still very much needed in the organization in the right slots. And then if we look at the results and relationships by executive role, it's roughly an equal balance. So there's no sort of more secrets hidden in there. So that balance is pretty equal between the CEO and the executives. Now, here's where it starts to get a little bit more interesting, because the three key metrics that are going to drive financial value creation are the financial goal drive, the innovation focus, and the fiscal control. And all three need to be reasonably strong. And the influencer, even though that they are the CEO of a lot of these companies, they fall off a bit on fiscal control. So they can be strong at driving the goals, generating the innovation or pushing the innovation and investing in it. But they need to be watched here, and there needs to be somebody on the executive team that's far stronger and is respected enough to manage the spending and the decision making, or the board needs to step in there. But otherwise, the authority bias of this person is going to have their way on the company. So again, this sort of gets to internal controls and how decisions are done. The better balance is coming from the initiators, because they're very goal driven, which, remember, that is the number one driver of profits. Strong innovation focus, and they're moderately strong enough on the fiscal control. So they're going to spend money on what's needed to be spent, and they're probably going to let go of the purse strings here and there when it's needed as well. So they're not going to choke the company. The risk with a strategist is, with the fiscal control and the financial prudence high, is they could choke the company. They're still pretty driven, but they could risk choking the company. That's what they need to be thinking about. And definitely they will be more challenged in investing in the people. And then we broke this down a little bit more to sort of look at the difference between the CEOs and the key executives on these three key metrics. And we can see that on the whole, the CEOs that have got stronger scores in more dominant scores in these three areas, the CEOs do better than actually the executive teams. So that's sending a message as well that, for these companies that are on the S&P 500, the CEOs, generally speaking, have a good enough strength in the three areas, and when you think that they potentially have a strong authority bias on the company and are going to influence the culture, this is I think a reasonably good balance and reflection of what should be happening. And it's okay that the executives aren't quite as balanced if they are focused on key roles. But again, somebody needs to be watching what's going on there in the fiscal control, and that's not allowed to run riot below the CEO there. And then just putting a graphic to this, and we are still working on getting all the graphics and things tidied up for this at the moment. But I think the graphic's good enough to show you that the maximum financial value trajectory is going to come when there is a a leadership team that is more dominated by the initiator, potentially the strategist. That's where overall more results are going to come from over the longer term, not just tomorrow, but over the longer term with those styles. You're going to have a well-controlled business if you've got the strategists and reflective thinkers at the helm of the leadership, and that might be needed where the company needs that kind of organizational structure. You know, there is some level of horses for courses with this, depending on where the company's at. What I would say for the influencer who are over here, they are going to drive exceptional growth, but it could be at the cost of the expense line, and so there'll be a little bit more boom and bust results. There'll be fast growth, but there'll be heavy investment in it, is likely what you're going to get with an influencer. So it's not, again, saying that they shouldn't be the CEOs of these companies. They're the charismatic leader. It's at the end of the day, it's about the balance. And we did some interesting research here, and it was lucky how some of it came up, because the first part came for me in February this year. I get a newsletter from Pricewaterhouse a couple of times a week, and their CEO had commissioned research on company CEOs out there and what were the issues for them. And 45% of those CEOs said that they didn't think their company would be in existence, or they were concerned their company would not be in existence by 2030. So if you think about it, that's in February this year, that's 7 years' time. They don't think their company will be there, primarily because of AI, and that they won't be able to keep up with the changes. They'll get wiped out by smaller companies that come up with an innovative product. And in essence, it also sort of, I think, brings to the fore that they haven't necessarily set themselves up organizationally as a leadership team to handle the innovation. What innovation do we invest in? Because just investing in, like many of these bigger companies are doing, in sort of what I call profit-enhancing, task-reducing type AI is one level that is good and is needed, but it's not going to transform the business. And it's those businesses that are going to invest in new products that are going to be transformative are the ones that are going to excel. And we see here, way ahead of everybody else, the information technology companies. So Pricewaterhouse, and again, this research came out on the 25th of July, just as we were finalizing this research, that it in a way, all the stars lined up, because what we could see here was what Pricewaterhouse was saying is the IT companies on average expect to get a 19% increase in profits because of their AI investments. Not all today. Some of them will be coming through tomorrow. We can see Facebook and Google making tremendous investments. Not all of them are showing dividends now, but they know that, and they're lucky they've got a lot of surplus cash that they can make those investments, but it's probably going to pay very big dividends. But when you look at the financial behaviors of those companies, they've got the right styles. And so interestingly, when we dissect our measurements against the industry sectors, it's very consistent. You're not getting down here where AI might be predicted to generate anything from 2 to 5% increase in profits. You haven't got as much innovation focus, and you haven't got strong fiscal controls, and you haven't got the competitive goal drive inside those companies. So if these companies want to move outside this area, they're going to have to potentially make fundamental leadership changes. And I think some of these ones here will have to look at that too. An area that has interested me on this journey is the influence of the CEO. And I've said this all along today, that the CEO has a very strong influence on their company, and they should. In America, one of the things I've noticed, perhaps being a little bit more of an outsider to America, is that a lot of CEOs are chairmen. So I asked the question, how many CEOs are also the chairman. It's 36%. Actually, it's lower than what I thought it was. I thought it might have been well above 50, but nevertheless, it does show that for those companies where the chairman and the CEO are the same person, you could bet that the authority bias, the ability of the CEO to influence the company's behavior and their results will be very strong. And then we can start to see it here where, again, 81% of the CEOs have a very strong authority bias. Again, no surprise, the influencer style is very strong there. And remember, they're pretty competitive to achieve the goals. They're innovation focused, but not as good on spending controls. And then you've got the initiator and the influencer, sorry, the initiator and the strategist, maybe not quite as dominant, but a bit more balanced there. So that's also some thinking in terms of leadership team and construction for boards to think about in terms of how these companies operate. But I will leave it that the CEO is generally speaking going to be a dominant influence, and it all starts at the top. And I don't think that should be any surprise to us. This is you don't need to read all of this, but this is just an example of what we've mocked up of how we plan to push Pegasus ratings out as its own business. And we wanted to become, in a way, the Morningstar of people assessment. Morningstar has been a great business over the last 40 years at putting a 5-star rating or 1 to 5-star rating on a company primarily based on financial analysis, because they haven't done the people analysis. We want to step in there and do the people analysis. And again, this is where Pegasus ratings can become the new gold standard for company research, due diligence, making key decisions. We're not saying Morningstar is irrelevant or these other sort of more news-based platforms are irrelevant. It's all relevant. It's all got to be utilized together in the mixing pot to come up with the decisions. But to only look at Morningstar ratings, to only look at news information services without looking at the people would be very remiss. So that's really how we see Pegasus ratings playing out. In our dream, Pegasus ratings will become its own dashboard that you can people who subscribe to it can tap into to get these insights. It would be updated real time. We can essentially do that now through our platform, but it's not there in that way for public consumption. So we'll only be doing it more on a project by project basis as we're requested to on demand in terms of this kind of leadership assessment. But in 2025, expect to see this out there big time as a subscriber service. So I did say at the end, I would tell you how much investment alpha can potentially be there because of financial behavior. And the grand number is 32%. So we did a simulation of the top 25 companies on financial value creation capability that are listed at the back of the detailed report. And they outperformed the S&P 500 SPY over a 5-year period by 32%. So the SPY went up 85%, and then add on 32%, and you get the number that portfolio would have generated. And I think what that's highlighting for you is that, and I alluded to this in one of my stories at the start, that the accounts tell you the results of the past, the leaders tell you the decisions of the future, and that really what we're talking about here is there will be outperformance in over the long term if you're backing the leaders. Now, I could say, because I had this discussion with somebody yesterday, that while I see the use of Pegasus for long-term portfolio building, it can be done for short-term plays as well, because we're humans. We'll all look at the same numbers differently because we're different and we've got different goals. If you're an investor and you're looking to short a company, you're going to be looking for that event that might give you the clue to whether to short the company, which is a relatively short-term position to take, and a management change might cause you to want to make that decision. So I think there are lots of purposes and lots of investment strategies that can be developed with the Pegasus ratings approach, with having more knowledge of the people. Ryan and I have been doing other simulations with other combinations of those companies, and they still all come out with outperformance. So, I think whichever way you come at it, behavior does make money. And then just to reiterate, how are we going to use this? So, if I start a little bit at the bottom, absolutely due diligence projects. We're working with one of the larger accounting firms on that area at the moment, where we can assess leaders of private companies and how should they be merged with others, how could they be divested, invested in, etc. Just the normal leadership development services. How can we help companies, including these S&P 500 companies, create more value? Building a better organizational development framework from the top down. How can we find that innovative person and elevate them to the chief of AI? I think it's a great project and a great opportunity to lift value in these companies. People have started to ask me about, well, how can we help a fund management group with portfolio design? So I think this data can be used for that. And then the holy grail, as far as this business is concerned, if Pegasus stands alone, is to have a subscription service with its own platform and dashboards. So at that point, I'm going to stop and let anyone ask questions they might have.
Yeah, Hugh, we had a couple questions.
Yep.
One from Hendrik pretty early on. How is the digital scan done? And if you remember, Hendrik was part of one of our executive roundtables a while back where we were unveiling it. Previous versions were based on public domain data. If not, how's the digital scan created?
Yeah, so the digital scan is created basically once we know the name of the person and where they currently work or operate from. So we've basically got them identified. And that's very easy, clearly, for the S&P 500 companies because all of those leaders are very visible. But really, for any person, once we know who they are, we then prompt our Microsoft platform where we've built a whole series of underlying prompts that go out to a whole range of public data sources, and it's bringing back words, language, roles, words and language that people have used, roles, a whole range of data sources. And then, through our machine learning processes, we're able to then feed that to answer the DNA discovery, and that then feeds to the production of the results in our system. And at the moment, we're getting between 75 and 80% reliability level across the board in terms of the results, because obviously we've been able to benchmark this against people that have completed the full scan profile as well. So we're getting pretty good results out of it. So that's essentially the process. And that process, to be honest, was not built overnight. We were actually asked to build that with a client or for a client back in 2017, and the client decided at the end of the day they didn't want to go further with the project for their own internal reasons, nothing to do with us or what we built. And we tinkered around with it, but we also knew that we needed technology on our side, which it is today with the proliferation of AI all over the place, and the Microsoft type platform being better for us to set this up. And now we're able to execute. So So in a way, this has been a six year or so journey to get to this place with the digital scan.
Thanks, Hugh. And not surprising, Linda Wittich had some great questions here. And
Yeah.
I said we could take them offline if we need to, but I think they're really good questions. First one is the primary goal of Pegasus on increasing alpha in our portfolios? Sort of investment.
So it's not just for investment portfolios. I think that's one application. I would like to emphasize that Pegasus ratings can be used for private companies as well. So we see a lot of the we see and think that a lot of the private equity and venture capital firms should be using it as a process for any of the decisions they make. We see around a private company leadership team that they're investing in, that they've got to manage. We see boards should be using it as part of the corporate governance process, as part of their oversight of the CEO and the leadership teams. We think the leaders should be using it as well to look at who they're investing in, understanding what their competitors are doing, and where their competitive drives might be coming from. Clearly, we want this to lead to an uplift of our full scan process, but I think there's a lot of uses there. And then even recruiting agencies, why wouldn't you use this if you want to recruit the best CEO for a board, or a board wants the best CEO for their company? Why wouldn't they use this as part of the process to get, part of that initial scanning done? They're just some of the uses. So it's not just for our own portfolios. I think that's one application. It's also for basically key decision making by companies and investors in public and private companies.
I think that kind of leads to the second question that she had, Hugh, and that's how close is the correlation between the S&P 500 leadership and those of early stage seed Series B? I know we've talked about that, with companies that are growth, startups. Is there a correlation?
It's going to be a very close correlation because, and I could give you more specific numbers on that, but we did a research study in 2007 of entrepreneurial founders of businesses who are the CEOs of their company. And we looked at the metrics of those leaders that built a business to $1 million, between 1 and 10 million, and then 10 million plus. And the behaviors got stronger and stronger as the business went past $10 million. And those same behaviors are part of that fabric. Certainly two of them are, being the competitive goal drive, and then the innovation, the risk taking, and the work ethic are closely correlated to this. And the only one that we really would add in there for the entrepreneur, the founder, is resilience. That's the number one trait.
Very good.
And I think you'll find a very close correlation.
Mm-hmm.
And we could do that research, because I think next year when I'm done with all of this and we've got this fully out there, I want to finish off a book that I've been writing about that behavior makes money, and I think that really plays into the work here, entrepreneurs, but also our financial behavior capability formula that we've used as the foundation for money energy is also highly correlated.
And then Linda's third question, Hugh, is do you feel that the publicly ingested information, which is often ghostwritten by the marketing team, does that really represent the CEO and the C-suite when we're doing the digital scanning?
Well, I think that's a good question. And I think what Linda is saying is that somebody could be a hard nut, results-driven person, and they've been softened up by a good ghostwriter, or Leon, you try and soften me up with ChatGPT at times. So that does play into it, but it's only that's only one part of the overall formula, and it's not going to be the dominant force on the formula. There are a lot of other, what I call more unbiased factors that can't be swayed that are going into that formula. So it's only a little bit of it.
Yeah. Right. And then a question from Hendrik here, Hugh. How do you see digital scan being used on a planner practice where limited information is available from like an investor that works with that financial advisor?
Well, that's really goes to the genesis of the award that we've won. The innovation award that we've won. We do see it being used by planning practices up front. When any new client comes in the door or prospect comes in the door, the digital scan can be deployed. Now, again, I've been asked this question a few times by people. For some people, some of the clients, there'll be an extensive amount of information out there. For others, there will be less information, or it will be further back in time. If you take, for example, my wife, she doesn't work anymore because she's at home looking after the kids. But there is still information about Jennifer out there in varying spots, and is what she did that still can be accessed, that are going to give you enough accuracy on this. And remember, this is only to start the conversation and to get things going. It's not necessarily the end of the journey, particularly in the planning practice.
Good, Hugh. And then Kenyatta sort of weighed in here. What about using the digital scan for other non-executive position roles within SOC codes? Is that possible?
Absolutely.
Absolutely.
This can be done to get you an organizational scan, say, of a whole company like Intel.
Exactly.
And if you want to get that picture get the organizational chart of Intel or Capgemini or whoever it is that you want to potentially see where the problem is, to heat map the organization, this can be done.
Great.
And I think we all should be, given our role, the different backgrounds of people on this call today, thinking of it like that. And I know there are others that will be looking at this in terms of, operational compliance, security, cybercrime. There's a whole raft of applications here.
Hugh, I think we've had the questions. Great job today, Hugh. Thank you very much for sharing this. We're pretty excited. And for everybody on the call, we will actually make this available, this video, and we'll send it out to you along with some notes. And we really do appreciate it. Would love any information that you have, just send it to me. I'll make sure that we roll it into this. But you'll be hearing more about Pegasus ratings over the next few weeks. I really appreciate everybody's time.
Yeah, and I think just to back that up, over time, we will be regularly doing work on this. There'll be other insights that come out, other helpful information snippets, infomercials will come out, how to use this better, insights on investing strategies. It's all going to come out of here, and we will keep you all fully informed so that you can do well personally from this, but also expand and grow your businesses.
All right. Thank you, Hugh. Appreciate it. Thanks everybody for joining.